Welcome to the deep dive. Today we're doing something a little different. We're zeroing in on one specific investment.
A hypothetical one, but based on real market data.
Exactly. We're looking at a $50,000 investment in Bitcoin made back on May 27th, 2024.
And tracking how it performed over the next year, right up to May 27th, 2025.
Our main source here is a report called A Year in Bitcoin, $50 investment growth. Pretty detailed stuff.
Yeah, it gives a good retrospective look.
And what we want you, the listener, to get out of this is a clearer picture of what really drove Bitcoin's, well, pretty significant growth during that period.
And maybe what that signals about finance more broadly.
So here's the hook to get us started. That 50 grand, it grew by nearly 60% in just 1 year.
Almost 60%. That's definitely worth digging into.
Okay, let's unpack that. Where do we start?
Well, let's ground ourselves in the numbers first. So May 27th, 2024, the price for one Bitcoin was $68,508.83.
Okay, so if you put in $50,000 then.
You would have bought approximately 0.73 Bitcoin. Let's call it 0.7303 BTC to be precise.
Right. Now, jump forward exactly 1 year, May 27th, 2025. What's the picture then?
Big difference. Bitcoin's price had climbed to $109,377.70 per coin.
Wow. So that same 0.73 Bitcoin
Is now worth roughly $79,837.79.
So the initial $50 turned into almost $80. That's a profit of nearly $30,000.
Precisely. A gain of $29,837.79, which works out to that 59.67% increase we mentioned.
That's impressive. But like you said, not just random market noise, there were specific things happening, right?
Absolutely. This wasn't just luck. It gets really interesting when you look at the key drivers, powerful forces at play.
Okay, let's get into those. First up, maybe the Bitcoin halving. That happened in April 2024, just before our investment window started.
Yeah, the halving is a huge part of the Bitcoin narrative. Basically, it's programmed into Bitcoin's code.
It cuts the reward for miners, doesn't it?
Exactly. Roughly every 4 years, the amount of new Bitcoin created with each block gets cut in half. This slows down the rate at which new coins enter circulation.
Kind of like quantitative tightening, but for Bitcoin. Built-in scarcity.
You got it. And since there's a maximum supply of 21 million Bitcoin ever, this reinforces that scarcity over time.
And historically, these halving events often lead to price increases, or at least that's the expectation.
That's been the pattern, yeah. Less new supply, same or growing demand. Basic economics suggests the price should rise. The April 20th, 2024 halving cut the reward from 6.25 Bitcoin per block down to 3.125.
So what actually happened in the market around that time? Did it follow the script?
It was interesting. There was a big run-up before the halving. Bitcoin hit a new all-time high around $73,750 back in March 2024.
Okay, so anticipation was high.
Definitely. Then on the actual halving day, the price was hovering around, say, $63,000, $64,000. But then counterintuitively, it dipped.
Oh.
Yeah, by early May 2024, it had dropped to around $58,500. Looked like a classic buy the rumor, sell the news scenario.
Oh, okay. So the event happens and people take profits.
Seems like it. But it didn't stay down for long. It bounced back pretty strongly, hitting over $70,000 again by May 21st, just before our investment date.
So that dip after the halving, does that suggest the market is getting better at pricing these things in beforehand?
I think that's a fair assessment. The fact it ran up so much before the halving and then pulled back suggests maybe the market, especially with more institutional players involved, is becoming more efficient. The supply reduction was known, baked in.
So the halving still matters for the long-term supply, but the short-term reaction was more nuanced this time.
Exactly. It reinforced the scarcity story, definitely. But the immediate price action wasn't just a straight line up like some might have expected based on past cycles. The market seems more sophisticated now.
And what about the miners? Cutting their reward in half sounds pretty tough.
Oh, it is. It puts serious pressure on their profit margins. Miners have to become way more efficient, find cheaper energy, maybe upgrade their hardware.
Could lead to consolidation, maybe. Bigger players squeezing out smaller ones.
Potentially, yes. It incentivizes efficiency and economies of scale. The network's security long-term then relies more heavily on Bitcoin's price staying high enough or transaction fees increasing significantly to keep miners profitable.
Okay, so the halving. Important background, complex reaction. What was the next big catalyst? The spot Bitcoin ETFs. Those seem like a huge deal.
Absolutely transformative. That's not an exaggeration. The SEC approval came on January 10th, 2024.
And these were different from previous Bitcoin products, right? Because they actually hold Bitcoin.
That's the key difference. Spot ETFs hold the underlying asset, actual Bitcoin. Previous futures-based ETFs tracked contracts, which is different. This opened up Bitcoin investment to a whole new class of investors.
Like institutions, pension funds, people using regular brokerage accounts?
Precisely. Suddenly, financial advisors could allocate client funds, institutions could get exposure without dealing with crypto exchanges directly. It bridged the gap between traditional finance and crypto.
And the money flowed in.
Did it ever? The inflows were just staggering. Look at BlackRock's ETF, IBEAT. In 2024 alone, it pulled in something like $37 billion, became one of the top ETFs globally, period.
37 billion.
Yep. And its assets under management, the total value it holds, actually overtook a major gold ETF, the iShares Gold Trust. That's symbolic.
Wow. And globally, these spot ETFs.
By April 2025, the total assets held in global spot Bitcoin ETFs had crossed $65 billion. And even into May 2025, we were still seeing really strong daily and weekly inflows. The demand was clearly there.
So how does that directly push the price up? Is it just the buying pressure?
That's the core mechanism. When someone buys a share of the spot ETF, the company issuing it, like BlackRock, has to go out and buy the equivalent amount of real Bitcoin on the open market to back that share.
So constant significant demand.
Exactly. Consistent buying pressure. But it was more than just the mechanics. It was also about accessibility and legitimacy.
Right. Suddenly it's in your retirement account. Options, maybe. Less scary, less niche.
Totally. It removed a lot of the friction and, frankly, some of the stigma. It was like getting Wall Street's seal of approval, which encouraged a lot of people who were maybe hesitant before.
So the scale of money coming in via ETFs was huge, and it changed the perception.
Massively. You saw Bitcoin moving from being viewed primarily as this, speculative digital token towards something more like an institutional grade asset. The comparison to digital gold really started to stick, especially when you see ETF assets surpassing actual gold funds.
And the regulators, seeing this success, must put pressure on them too.
You'd think so. The sheer volume and demand probably encouraged bodies like the SEC and CFTC to think more seriously about frameworks for other digital assets, too. There was talk about spot Ether ETFs potentially following.
So the ETF effect was multi-layered. Direct buying, increased accessibility, and a shift in perception.
Couldn't have said it better myself. It was a major catalyst during this period.
Okay, but institutional interest wasn't just about ETFs, right? The report mentions other forms of adoption picking up steam, too.
That's a key point. Inspired perhaps by early movers like MicroStrategy, now called Strategy, apparently we saw a big jump in corporations adding Bitcoin to their balance sheets.
Now big a jump.
Corporate treasury allocations reportedly increased by 147% year over year in 2025. Strategy kept buying, of course, but you also saw companies outside the U.S., like Metaplanet in Japan, making significant Bitcoin purchases for their reserves in May 2025.
Interesting. And it wasn't just companies, but also wealth managers.
Yes, financial advisors started integrating Bitcoin more into client portfolios. Maybe a small percentage, 1%, 5%, depending on the client's risk appetite. Even big names like Morgan Stanley were reportedly recommending allocations like 2-5%, seeing it as a diversifier or inflation hedge.
Okay, that makes sense. But then there's the mention of sovereign wealth funds. That feels like another level entirely.
That's potentially game-changing territory. The report projected that we might see at least one G20 central bank or maybe major public pension systems starting to allocate to Bitcoin.
Wow. Nation-states holding Bitcoin.
If that happens widely, yes. And it's not just theoretical. By this point, institutions, broadly defined, were estimated to hold around 8% of all circulating Bitcoin, seeing governments or sovereign funds even consider it. That really signals a profound shift in how Bitcoin is being perceived globally. Less as fringe tech, more as a potential strategic reserve asset.
That definitely elevates the conversation. Okay, let's broaden out again. What about the wider economy? Macro factors, geopolitics, did they play a role?
They certainly seem to. Around mid-May 2025, there was renewed optimism that the U.S. Federal Reserve might start cutting interest rates again.
And lower rates generally boost riskier assets.
Typically, yes. Lower rates make holding non-yielding assets like Bitcoin relatively more attractive. The opportunity cost goes down, so that boosted sentiment.
And geopolitics. Trade deals were mentioned.
Right. There was positive buzz around a potential U.S.-UK trade deal, and also some easing of U.S.-China trade tensions with a tentative tariff agreement. Both seemed to calm market jitters around May 8th and May 12th, 2025.
Less fear in the markets helps crypto too.
It often does. When global risk appetite improves, assets like Bitcoin often benefit. There was also mention of the M2 money supply increasing, suggesting more liquidity in the system, which can also push asset prices up.
So if we connect the dots here, Bitcoin seems to be reacting more like a traditional macro asset now, responding to Fed expectations,
Yeah.
trade news.
Increasingly so, yes. It suggests deeper integration into the global financial system, and it reinforces the narrative for some investors that Bitcoin can act as a hedge against, fiat currency debasement or worries about government debt levels.
Fascinating.
Mhm.
And related to geopolitics, but more specific, was the shift in the U.S. political stance on crypto. That seemed significant.
Very significant, especially from January 2025 onwards. The incoming Trump administration took a notably more pro-crypto position than previous ones.
What did that look like in practice?
Several things. Announcing plans for a strategic Bitcoin reserve, appointing leaders at the SEC perceived as more crypto-friendly, endorsing stablecoin regulation. President Trump himself made statements about wanting the U.S. to be the crypto capital of the world.
A strategic Bitcoin reserve, like the Strategic Petroleum Reserve, but for Bitcoin.
That was the idea floated. An executive order in January 2025 set up a working group to look into crypto-friendly rules and investigate creating this national reserve. There was even a mention on Truth Social in March 2025 about exploring federal purchases of Bitcoin and other major cryptos like Ethereum, XRP, Solana, ADA.
That's bold. How did the market react?
Well, interestingly, there was a bit of a price drop initially after the January executive order from around $108,000 down to $84,000 by March. Another potential sell the news moment or maybe just market volatility.
But the overall signal was positive for crypto adoption in the U.S.
Overwhelmingly positive signal, yes. It likely boosted confidence, especially among investors who might have been worried about regulatory crackdowns. The idea of a major global power openly embracing Bitcoin, even considering holding it strategically, that raises some profound questions about its future role.
Absolutely. Okay, so we've covered the big drivers: halving, ETFs, institutional adoption, macro, politics. Let's look at the price journey itself during that year. Did it reflect these catalysts?
Broadly, yes. If you track the price from May 2024 to May 2025, you see the story unfold. Starting around $68,500, there were some ups and downs over the summer of 2024, even a dip below $54,000 in August.
Okay, so not a straight line up initially.
No. But then late 2024 saw a strong rally. That's when anticipation for the ETFs was really building, plus the first hints of Fed rate cuts. Bitcoin broke $100,000 for the first time in December 2024.
Fueled by ETF hype.
Largely, yes. Early 2025 saw more gains right after the ETF approvals in January. But then came that correction in March we mentioned, possibly related to the initial policy announcements settling in.
And then the recovery towards the end of our period.
Right. April and May 2025 saw the price climb back up, getting over $100,000 again. This seemed linked to renewed hopes for rate cuts and those positive trade developments. It ended our year, May 27th, 2025, around that $109,000 mark.
So the timeline definitely seems to map onto those major events we discussed. Now, how did Bitcoin do compared to other cryptocurrencies, the altcoins, during this time?
The altcoin market. It was a bit of a mixed bag. 2024 saw some really impressive gains for coins like Ripple, XRP, Solana, Ethereum, Cardano. They did very well.
But did that continue into 2025?
Not uniformly. The first quarter of 2025 was tough for many alts. Ethereum apparently gave back all its 2024 gains. Solana and Cardano lost about half. Ripple, interestingly, held up better.
So a divergence there. Did they recover later?
There was a bit of a rally in some alts mid-May 2025. Ethereum saw some positive movement, maybe linked to an upgrade called Pectra, and Solana, XRP, others saw gains too, but overall,
Bitcoin still led the charge.
it seemed that way. There's something called the Altcoin Season Index, and in late May 2025, it was still showing a low score, like 23 out of 100. That indicates Bitcoin dominance was still very much the theme.
What does that tell us? Maybe a flight to quality?
That's a good way to put it, especially with institutions entering via ETFs that were primarily focused on Bitcoin. It's bigger, more liquid, seen as relatively less risky than smaller altcoins.
So Bitcoin was acting as the main anchor,
Uh-huh.
especially for that new institutional money.
Exactly. While alts can have spectacular runs, Bitcoin really solidified its position as the foundational asset in the crypto space during this period.
Okay, one last piece. Market sentiment and volatility. Did things calm down at all?
That's another really interesting trend noted in the report. By mid-2025, Bitcoin's realized volatility, how much its price actually fluctuated day to day, had dropped significantly.
How significantly?
Potentially down by as much as 75% from some of its earlier peaks. That's a big reduction.
And why was that happening? The ETS again.
That was the main attribution, yes. The argument is that having regulated products like spot ETFs brings in more long-term investors, more institutional players, leading to more orderly trading compared to the purely retail-driven mania of the past.
Makes sense. Less wild swings make it more palatable for conservative institutions.
Precisely. It becomes more attractive if it's not quite so stomach-churning day to day, which leads to an interesting question.
Is Bitcoin getting boring? In a good way, maybe?
Perhaps. Less volatile, more predictable. That might be exactly what long-term institutional investors want to see. It certainly makes the investment case easier for some.
Okay, so let's try and rack this all up. That hypothetical $50,000 investment back in May 2024 saw incredible growth, nearly 60% by May 2025.
And it wasn't just one thing. It was really a convergence of powerful factors.
It had the halving reducing supply,
The game-changing spot ETFs bringing in massive institutional flows.
growing adoption by corporations and potentially even sovereign funds,
Favorable macro wins like hopes for lower interest rates.
and a supportive political shift in the U.S. towards crypto.
It was quite the confluence of events, all pushing in the same direction, more or less.
Looking forward from that point in May 2025, what seemed like the potential trajectory.
Well, continued integration into finance seemed likely, more regulatory clarity hopefully developing. Some analysts were throwing out pretty high price targets for the end of 2025, 150K, maybe even 180K.
Ambitious.
Very. And the expectation was perhaps for continued market maturation, maybe volatility continuing to dampen somewhat over the long term.
But always risks, right? Potential headwinds.
Always. Unexpected geopolitical events, sudden shifts in central bank policy, maybe another boom and bust cycle in the altcoin market spilling over. Nothing's guaranteed.
Okay, so that brings us to our final thought for you, the listener. Given everything we've discussed, the ETFs, the institutional embrace, even talk of government reserves.
Is Bitcoin transitioning from being this, disruptive, revolutionary outsider asset to becoming more like a fundamental piece of the established global financial system? And if so, what does that mean for its long-term potential? Does it become more stable but maybe offer less explosive upside? How does it change your own understanding of value in this digital age?
Something to think about. That's our deep dive for today. Thanks for tuning in.